Stocks slip as the rupee opens at a record low, breaching the 90 per dollar mark. The Nifty gives up 26,000. In fact, as we speak, it's around 25,900. Except the IT index, all trade with losses. The broader markets fare worse off than the key indices.
Angel One slumps on a very weak business update as the market share and the client acquisition both slip in November.
Indus Towers gains in a weak market following a high conviction buy rating coming in from Citi. The brokerage has set a target of 500 rupees for the stock after telecom ministers encouraging comments on relief for Vodafone Idea.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the markets are trading in the red today, though the Nifty is hovering around the 20 DMA, and the bulls will be optimistic that we can see some sort of support that's coming in from these particular levels. And the big story, Mangalam, today has been the Indian rupee, gone to around 90 odd mark. The hope is that we see some kind of stability in this vicinity of around 90 to around 91 odd. I think the last time I checked the Indian rupee as well, more or less stable at around 90.11 or thereabouts. We have an RBI meet as well, so interesting to see whether or not they've got a plan in terms of curtailment of this and what is their comfort level on the Indian rupee.
We will definitely monitor how that progresses, and the RBI usually, monitors volatility more than the big move on the rupee itself. So we'll track how that goes. Currently at around 90.1, the FII flows, whether they exacerbate because of the weakening rupee or not, is something that we'll be tracking as well. But important technical levels, the market's holding so far, and typically, when all of this happens, there is flight to some safety, and that's something that we're seeing. Obviously, the beneficiary of a weaker rupee is the IT index. So the IT index has actually moved to the high point of trade and is a fair weight on the Nifty as well. So that stems the downtick on the Nifty that we're seeing right now. And the other is the FMCG pack, which opened in the red, but the FMCG index has now moved fairly well from the lows as well. So those are a couple of sectors that we'll be tracking. Good time to get in Chandan Thaparia of Motilal Oswal Financial Services. Chandan, we've corrected about, 400 points from the record high on the Nifty. Do you think this is routine and we will see some support here?
Good morning, Mangalam and Nigel. Thanks for having me. So, market just hit an all-time high of 26,325 just 3 days back. But after that, it fell to cheer the momentum led by weakening rupee, which is now beyond 90.12 marks. FI's flow is still not in back. However, FI's long-short ratio is hovering near 15-18%. VIX is still at lower levels. DIs are continuously buying. But somehow the rupee is changing the stance, and that's why the market is finding some hiccup at its all-time high. So I believe some sort of consolidation could be there. Sector rotation might play an important role. However, the major trend of the market is untapped to positive, but on short-term point of view, the structure is slightly turning lower, and index has been making lower top, lower bottom on the daily chart. And however, it formed a bearish belt hold on the weekly chart as of now. So I believe the market can retest the key support near 25,700, 750 before it starts the next leg of rally. And I believe upcoming RBI policy is also an important part. However, the data front, we have seen so many positive trends. GDP data at 8.2%, inflation is at 20 years low level of 0.25. But yes, somehow the stability of the rupee is important. So to sum up all, I believe 25,700, 25,750 could provide as a major support in Nifty index. Talking about Bank Nifty index, Bank Nifty has been outperforming, but witnessed some profit booking in last 2-3 trading session. It made an all-time high beyond 60,000 marks, but corrected by more than 1,500 points from high. So as of now, 58,500 is an important support for Bank Nifty index. Now talking about trading ideas, now the sector and the stock specific action has shifted comparatively, looking at the declining market and change in the rupee and the movement in the precious metal. So first trade is buy on Hindustan Zinc. We have seen good momentum in the gold and silver, and Hindustan Zinc is proxy of the silver in terms of equity trading. So stock has been making high tops, high bottom. In fact, the rollovers were better by more than 82% with higher roll cost. We have seen addition of long built up. So Hindustan Zinc will be the first trading idea. With support of 496, we are looking for an upside move towards 525, 528. Second trading idea, that is buy on Wipro. Positive on the selective IT name, and Wipro has seen a consolidation breakout, has been making high tops, high bottom with some put writing activity, so momentum could continue. Delivery volume is also inching upwards, so one can buy with support of 250 for an upside target towards 269. Last trading idea, that is sell on LICI. The stock is given a breakdown. We have seen sustained call writing, huge built up of short position with short rollover. So one can sell with stop loss of 893 and this counter can drip down to us 845, 840 marks.
Got it. Okay. All right. Thanks a lot for that, Chandan. 25,700, 25,750 mark, the important, crucial support as per what Chandan says, not ruling out that we go there and revisit that particular level. But let's shift focus to our special segment where we get a few ideas for profit from Money Control Pro. Madhu Chanda De of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about Control Print, which is one of the leading players in the oligopolistic coding and marking business, dominated mostly by MNC players in India. The company came out with a very decent set of numbers in the quarter gone by. While there was a sequential improvement in gross margin on the back of better product mix, what was really surprising was the strong 28% EBITDA margin. Operating leverage benefit clearly appears to be at play. The company's track and trace solution brands also seems to be gaining traction. The company is implementing 2 major projects with pharmaceutical clients, and the outlook seems to be bright. With GST rationalization energizing a lot of user industries, the outlook seems to be improving incrementally. The overseas packaging business appears to be the only drag, and the company has taken several initiatives, and the losses are expected to narrow, and the company could break even by FY27. As a thumb rule, the growth in the industry is almost 1.5 times the growth in GDP. Control Print has a very strong balance sheet and has a reasonable valuation for the secular growth opportunity it offers.
Thanks a lot for that, Madhu. For the time being, we slip into a short break. On the other side, we'll get back with Mr. Arvind Meligiri, the Executive Chairman and Chief Executive Officer at Aequs, who's going to be joining in to explain their IPO that opens up today. Stay tuned.
You're watching us here on Chartbusters. As promised, let's get chatting with the management of precision component manufacturer Aequs. Their 920 crore IPO opens for subscription. Arvind Meligiri, who's the executive chairman and the CEO of the company, joins us now in the studio. Thanks a lot for joining. It's an interesting company. You have 2 verticals, aerospace and consumer, which you recently started, the consumer segment. Let's start with the objects of your issue first. You are looking to repay debt worth 430 crores and put capex for the 60 crores. If you could give us a sense on what does that do to your balance sheet in terms of debt reduction, reduction in interest costs, and the capex that you're putting in. How much additional revenue does that get you?
Today, about 530 crore debt, and we'll pay majority of the debt through this fundraising, and that will reduce our interest cost definitely and help our profitability perspective.
By about 30-40 crores?
30-40 crore perspective.
And the 65 crores that you're putting asset on?
We should be able to do it. That's predominantly for aerospace. Historically, we have done 2 times the capital employed, and that should be able to add additional revenue corresponding to that.
All right. Just to do some rough math, you're functioning at approximately 44% or thereabouts of capacity utilization, and you're ballpark around 1,000 crores. Now you're going to be getting another 120 crores from this capex that you're putting in. So the revenue potential, I'm not asking for the guidance, the regulators will be happy, your bankers will be happy, no tension on that front. The peak revenue potential with the current gross block will be around 2,000, 2,100 crores. Is that fair to say?
It's fair.
Okay, all right. Let's get a little bit deeper then. As you said, aerospace is bulk of your revenues. Could you tell us how the mix will move? Because consumer segment as a percentage, I think it was around 20% of your total mix, 10 to 20%, 100, 200 crores or thereabouts. So what is your ideal mix you're looking at in terms of contribution coming in from this consumer segment?
Yeah, if you look at it, our utilization perspective, you need to split between aerospace and consumer.
Yes.
Aerospace is already at about 67 to 70%.
Got it. Okay.
So we are fully utilized the capital, whatever we have. That's why putting more capital. We have invested about 600 crore capital into consumer electronics. So that capital is yet to be generating the revenue, and that's why our utilization is only 22%. So as that utilization happens, that's when the revenue and profitability will shift.
So if we were to look at your potential 2,000 crore revenue, which happens over the next 2 to 3 years basis, your increased utilization and getting clients, etc., 1,000, 1,100 would be coming in from aerospace, and around 900 to 1,000 would be coming in from consumer electronics, making it 50-50. Would that be the ideal?
No, aerospace continues to grow at about 20% because we have a 20% growth last 4 years CAGR. If you look at order book of aerospace industry is booked for next 10 years. So it's a utilization is continue to improve and capex continue to happen. It's a very capex intensive industry what we are in. Yes, a capex led growth.
Also high barriers to entry.
High barriers to entry.
Yeah.
And we are one of the uniquely positioned, vertically integrated, engineering, precision manufacturing capabilities we have built in India.
And the consumer business?
Consumer business also very similar, high precision manufacturing. And we are predominantly in mechanical products of consumer electronics industry.
Right.
We don't do electronics.
Right.
We're just qualified for electronic consumer component manufacturing scheme, ECMS scheme, and under mechanics recently. Okay. So that's part of the growth story.
All right. What about your EBITDA number? I'm looking at your last number. The margins that we have got out here is you're doing around mid-teens margins. Can you maintain it in this range? Are you satisfied?
Actually, our aerospace does much more. If you look at
So give us the margins.
yes.
Beautiful.
Aerospace is 20% level. Aerospace and consumer is obviously less because of the consumer being not utilized. Our margins are less overall.
So there's an
Once
upside.
the utilization comes in, what does the consumer business margin settle at?
We are directing in the same level of where we are.
So eventually, at a 2,000 crore utilization for revenue, your margins would be about 20%. That would be a fair estimate, right?
Estimate, yeah. I mean, that's where we aspiration is to get there.
And this happens by when? As per you, I mean, FY 28, 29?
No, it's a journey. Capex and the utilization and all the utilization and also the qualifications. All these are part of journey, and we do see in a near term to get there.
Okay.
In the near term, what is near term?
Look, utilization is moving every quarter up. So another another 4 quarters we can see some.
Okay, give us a sense on your working capital cycle.
Yeah, typically we are about 120 days net on the sales, 120 days net working capital on the sales, and we feel that very similar on both on consumer and aerospace side.
So you're happy, you're comfortable at 120 days.
Yeah, I think that's very, very good for aerospace.
You're come at an opportune time because if I look at your breakup, the exports are a large part of your business, and even the domestic sales, they're deemed exports. Yeah. So people will say, that y'all are very well placed because the rupee is depreciating. The market is nervous, but they'll say y'all could be a potential winner. Clarify this to us. Yeah. Will y'all gain if the rupee depreciates because your sales numbers will move up, but you'll have a fair bit of imports as well in dollar terms. So that could nullify some part of it. And net, will it be a big benefit or is it a marginal benefit?
I mean, it's a marginal benefit. It's not a big benefit because we do high level of value add. Typically, our material costs are about anywhere between 30 to 50% in our products.
Got it.
And remaining is all value add. So that tends to benefit certain extent. But we also have a large capex, which mostly imported. So that offsets to certain extent.
So about 80% of your expenditure is in dollars and 100% of your revenues are in dollars. So that 20%, any change happens, that would be no more than 3 to 4% back of the envelope calculation. All right. Final question before we let you go. Aerospace, we know there are a few companies in the world that make products for airlines, etc. And those are your clients. When it comes to the consumer electronics business, there are so many clients. Who have you gotten authorizations from? And who are the others that you're in talks with right now? We want to understand your client profile.
Look, I mean, we are predominantly high precision machining kind of activities, metallics products. And, we are working on this industry. We have actually, if you look at consumer, we have consumer plastics piece and consumer electronics piece.
Got it.
And we have another piece, which is cookware, which is joint venture with Tramontina of Brazil.
Okay.
So it's 3 pieces of business, what we have. And consumer toys, we have basically making for Hasbro and Spin Master. Okay. And some of the customers in consumer electronics, at this time, we cannot be in a position to talk about it.
All right. And both Nigel and I,
while one of the large consumer electronic company in the world.
All right. We'll wish you good luck for the IPO. Look forward to your listing. Press you a little more on your numbers, your outlook once the listing happens. But also at the same time, you said you have a tie with people in Brazil. Maybe Nigel and I will probably come down to your Brazil factory as well. And, look at all of that while, talking about your business.
Wish you all the best, sir.
Thank you.
On numbers, regulator will be on board. Bank will be okay as well. We'll squeeze you a little bit for the near-term outlook. But thanks a lot for joining in.
Thank you.
Explaining your business to us.
Thank you. Thanks for the opportunity.
Well, for the time being, we'll slip into a short break. Come back, continue to focus on markets as well as on stock-specific action. Don't go anywhere.
Welcome back. Among the stocks of the day yesterday was Asian Paints. The top Nifty gainer has actually gained about 40% from its recent lows on improving demand environment, but more importantly, reducing competitive intensity as well, at least as far as the perception is concerned. In an exclusive conversation with CNBC-TV18, the management decoded the events of the last 2 years and more importantly, tells us what the future looks like. Hear it out.
This time was very, very exhilarating because we felt that, there were lots happening in the marketplace. There was lots happening at the competitive ends to that extent, and the market was not very great from a point of view of a demand perspective. So I think there were challenges all across in terms of what came in, and what possibly occupied my attention was that during these times, how do we really navigate the brand and really take it ahead and look at possibly playing to our strengths and really seeing that we are scoring centuries as we kind of do stuff.
All right, and 2 years later, as you stand, consumer sentiment is at the inflection point of improvement. Competitive intensity, while it stays, the disruptor is not the disruptor anymore, is an incumbent. And at the same time, you have a lot of your business excellence, etc., consolidated. So from where we are, how do the next 2 years look to you?
So if you look at even now, while you are seeing some shoots in terms of the demand, we are not seeing that there is belligerence, there is full exhilaration coming into the market to that extent. We feel that today the rural markets are just coming back, even the urban centers are just trying to show some spark. I feel that possibly it will take some time before we really get onto the parameter of really double digits and so on and so forth.
How long will it take?
It's very difficult to say, but I would say that possibly another 2 quarters is something we need to kind of watch out for sure in terms of what we are looking at. So therefore, right now, I think the whole peg is in terms of saying that we continue to grow higher than the market, and that's the pitch in terms of what we would take.
And you haven't been doing so for the last few quarters, and now you're confident of doing that, right?
The first 2 quarters of this year, we have grown higher than the market to that extent. And as you look at the H1, we have grown much higher than the market overall.
So you will continue to gain market share.
That's absolutely.
And that still holds with 18 to 20% margins, because now whatever savings you will get, you will deploy it back towards building the brand, building growth.
Absolutely.
So say high single digit sort of revenue growth, double digit volume growth, and 18 to 20% margins is the new normal for Asian Paints.
So that's the margin guidance which we have always maintained. And I think the great part is that despite all what we have seen in the market, we have kept our head on the shoulders in terms of what we are doing. We've not kind of taken the whole route of discounting or pricing in terms of that, but we've taken the route in terms of building the brand and playing to our strengths.
What are you most proud of over the last 2 years?
I think the fact that we have been able to kind of really build the brand to a new high, and what we have been able to kind of get nuances and being very strongly related with home as a brand which no other brand is. So I would say that Asian Paints' whole attempt to kind of really get into the consumer's mind has been very, very strong, and we think we are appropriating home more than ever before.
What are you most disappointed by over the last 2 years? What is the one thing what do you regret the most over the last 2 years?
I would say that from a point of view of saying that we would have liked to grow much faster. I think that is something which possibly I regret to that extent. I think we could have possibly put more drivers in terms of looking at what we could have driven the market far more strongly. But I think given the circumstances, I would say it has been quite good in terms of what we have performed.
What have you done to ensure that your dealerships stay while within the guardrails of the law?
So we felt that one of the big things which has held by us is the relationships. It's not only about business, it's not only about margins, it's not about profitability. It's about relationships, it's your personalization, it's your ability to kind of really be empathetic about the business in terms of what you're dealing in. And I think that's something which I have tried, that it's not only me, the face of Asian Paints, but my entire leadership and my people who believe in that relationship very, very strongly. And that is something which I think is the trump card which Asian Paints hold.
And it's not just them, right? It's not just the disruptor. It's also the other incumbents, because everyone who's entering the industry right now, they respect you. Obviously, they say that we want to aim at being the number 2 player in the country. But when everyone is looking at the number 2 place, the number 2 also wants to ensure that they are number 2, and the number 3 also wants to ensure that they are not ceding any ground. So that on the whole becomes like a big pressure cooker situation for the industry. Have you faced that as well?
I think this pressure has always been there. You know, if I look back last 2 decades, it's been always there. Just that today the number of players who are coming and trying to take a dig at it is much more to that extent. And I think that's something which is good because it also, as a leader, keeps us on toes in terms of thinking what is the differential thing in terms of what you are kind of really talking of. And that's why I keep on saying that, you know, we will keep on creating trends. People have to make case studies out of it.
And to the investors, what will you say, who've been sitting on 2 years of losses?
I think the investors will see that this is a brand which they will have to watch out for because there are lots of things which are coming, and we think that possibly we have our clear eyes on the stakeholders and we will give them a good return.
All right, a good return for stakeholders. That's the promise coming in from Asian Paints. Samit Singhal, the MD and CEO. You can catch him all day today on CNBC-TV18. Right, with that, we wrap up on this edition of Chartbusters with the news that the market continues to reel under a wee bit of pressure, but does it continue to stay there or does it recover? For all of that, you stay tuned. Trading Hour comes up next.